Alright, welcome everybody. If you've ever thought investing was only for Wall Street pros or people who already have millions in the bank, let me stop you right there. Investing is for you. Whether you're a college student with $50 or a grown professional with a steady paycheck, you can start building wealth today. And that's exactly what part 1 of this series is all about. Understanding the basics of investing so you can step confidently into the game. So first, let's answer the big question. Why even invest? It comes down to one thing. Your money can work harder than you ever could. If you just leave cash in a savings account, it grows at maybe 0.5% a year. Inflation? About 2-3% a year. That means you're losing purchasing power. But when you invest wisely in stocks, bonds, ETFs, real estate, even businesses, your money can grow faster than inflation, creating wealth over time. That's how people retire comfortably, pay for their kids' college, or buy that dream house. Here's the magic sauce: compound interest. Albert Einstein supposedly called it the 8th wonder of the world. Basically, you earn returns not just on your money, but on the growth your money already made. Example, let's say you invest $1,000 and earn 10% in a year. That's $1,100. Next year, you don't just earn 10% on $1,000. You earn it on $1,100. That's $1,210. Over decades, this snowballs. That's how small, consistent investments turn into 6 figures, even 7 figures over time. Now here's the trade-off. With investing, there's no reward without risk. The stock market can go up and down. Some investments, like government bonds, are safer but grow slower. Stocks grow faster on average, but they're bumpy. The key is learning to balance risk and reward based on your goals and timeline. And don't worry, in this series we'll break down exactly how to do that. Before we go any deeper, let's define some terms you'll hear all the time. Stock, a piece of ownership in a company. Bond, a loan you give to a company or government that pays you back with interest. ETF, exchange-traded fund. A basket of investments, like a mix of 500 big companies in the S&P 500 that you can buy like a stock. Portfolio, your collection of investments. Diversification, the old don't put all your eggs in one basket rule, spreading your money across different investments to lower risk. A huge mistake beginners make, thinking they can time the market. Truth is, even the smartest investors can't consistently guess the perfect day to buy or sell. What does work? Staying invested over time. That's why people say, time in the market beats timing the market. The earlier you start, the more compounding works for you. So how do you start? Here are 3 beginner steps. Set your foundation. Make sure you've got an emergency fund and aren't drowning in high-interest debt. Pick your platform. Apps like Fidelity, Schwab, Vanguard, or beginner-friendly ones like Robinhood and Webull are all options. Start simple. Buy broad market ETFs like the S&P 500 Index Fund. It gives you instant diversification without needing to pick stocks. Alright, that's part 1. Today, you learned why investing matters, the power of compound interest, and the basic building blocks like stocks, bonds, and ETFs. In part 2, we're going to dive into how to actually open an account, set up automatic investing, and choose between different strategies. So if you want to build your financial future, hit that subscribe button. Share this with a friend who needs to start investing, and get ready for part 2. Because the best time to start was yesterday, the second best time is today.